get scared now.
They may take our lives, but they'll never take our freedom!
Cinderella story out of nowhere.
It's in the hole! That the only thing we have to fear is fear itself!
Welcome back to Capital Hacking. John Edwin, thank you for being here today.
Thank you so much, Josh. And we have a great show lined up for you guys today. Gary Jonas from the How Group is on. He's going to talk about the downsides of real estate, the upsides of real estate, the goods, the bads, the uglies. He's going to talk about the current state of our economy and what his predictions are.
He does a great job of a lot of background on what's going on in the world today, how tough it is out there, and what innovations he's coming up with. So if you have a portfolio and a business and you want to try to pivot, this is going to be inspirational for you. And the name of his company is How, H-O-W, which I always find odd. It's a very popular business around here. We see the signs a lot. But wait till you hear why he named it How. I think you're going to love it. The whole price of admission is worth just that story. And I think we're going to name the show something like How, see, there you go, how to lose money and still sleep at night in a brutal real estate market with a great guy. Wait till you hear this show.
Let's go.
John, as I always say, isn't it incredible to get guests like Mr. Gary Jonas?
Man, you know, Gary, he never ceases to amaze me, this guy. He owns a company called the How Group. They have a management business, construction business, a real estate and development. Good friend of both of ours. And we're so excited to have you on the show, Gary. Give us a little background in your story.
Yeah, well, number one, thank you for having me. I love both of you guys. You're awesome. The quick background is I'm a Philadelphia guy, born and raised, and started out of college in the mortgage business, saw that people were making a lot of money in real estate and decided we needed to be in that space. And as we got into that space, we just felt like we could do each of the processes a little bit better than other people. And that turned into kind of full service mortgage /development /property management, all of that stuff under one roof.
What a nice, succinct way to say it. I'm sorry that I stepped on you, John. I didn't mean to. And by the way, the name of the company now is HOW. Is there a meaning? Because I've always thought I see the trucks, I see the billboards, not billboards, but job posters, or what do you call those? Job screen walls where you know your name is on really prominent projects in the Philadelphia Metroplex. But what does that mean to you, that name?
So I saw a sign in a conference room one time and it said, the answer is yes, let's figure out how. And I liked it and thought that it was a good message and a good core value that, like, we're here to, our job is to solve problems. So we got to start with the premise that we're yes people and then figure it out.
Yeah. So with the real estate space, you started in the mortgage industry and then started buying your own properties. How did that work?
Yeah, so I read Rich Dad, Poor Dad and was working in mortgage and kind of looking at where people were making money. And so I had a goal of buying 10 properties and having them paid off by the time I was 45 and retiring. That was the grand goal. So I went out and bought a bunch of single family properties in Manayunk over a period of time. And eventually we started realizing that I couldn't make any cash flow in, single family properties, but I was building all this equity up. And so we sold those properties and took that equity and used that to start buying multifamily properties. And then that just kind of snowballed. We got in the market at exactly the right time, right when everything was at the bottom of the market. We had no inventory and have had a 10 to 15 year run of interest rates going down and market values going up. And it's just been wonderful.
You just tripped into some awesome lessons that you could teach us, like 3 really awesome lessons. And part of the salient thing we're going to get done in this big show is we're going to teach people that we're in a brutal market right now. And how do you deal with that? And now we're going to learn from you. Let's go back to the young Gary Jonas. You had just pivoted your mind away from 10 properties by 45 to becoming more of an investor, entrepreneur. but you got in with no inventory during a down market. Now that sounds perfect, right? Because that means you're buying inventory when it's affordable and you don't have any past legacy projects that are pulling your whole portfolio down. That's how you began, and you said you timed it perfectly. Where are we today? And could you just tell us what you learned in that time and what you're learning now in this brutal market, as you call it?
Yeah, so two different things, right? So we were in the mortgage business at the time. Financial crisis hits. We have to pivot in the mortgage business, and we basically start working for a bank and run their mortgage banking platform. That freed me up to get into the real estate at the time where things were perfect. For the last 15 years, everybody thinks I'm a genius. This year, I have every problem that happened in the last real estate cycle happening to me, right? Which is interest rates have gone up while I'm in the middle of developing 500 units. Construction costs has gone up by 30 or 40% while I'm in the middle of developing 500 units, right? I'm the construction company. I'm the development company. I'm the property management company. There's nobody to point to when there's money overages other than me, right? So that's why people wanted to do business with us. But what that means is that all the money that we had built up, and generally, let me back up. Generally, like when I had told you, hey, we have a mortgage company, we have a real estate company, we have a rental, development company where we're building rental properties, you would think when sales are down on the residential side and nobody's doing mortgages, well, at least a lot of people are renting, so I can make money over here. But I got the perfect storm of nobody buying a house because there's no inventory, nobody getting a mortgage because there's no houses being bought, and interest rates are through the roof, and all the costs on the rental stuff going through the roof. So I'm losing money on every one of those companies right now, every one of them. And
so talk about brutal.
That beckons the question for you, Gary.
Mm-hmm.
How do you sleep at night?
So here's the answer, John. A couple things. One, our job is to protect our downside as much as we possibly can, right? So I have some interest rate protection above a certain rate. So I can sleep at night knowing, hey, look, my rate went up and that's going to cause me some problems in the short term, but I've protected myself long-term against that interest rate risk. So what that means is I got to get through this year and half of next year where I've got no real revenue, no real cash flow from the operating businesses. Now, the good news is I still own a bunch of stabilized properties, which pays me cash flow. So I might make half of what I made last year. All my operating businesses might lose money, but the properties that are sending me checks every month, they're still paying me, right? And it gives me an opportunity to go, well, look, I expanded this company. I hired all these people and, the unemployment's low. You're not, you're filling positions and you don't have all 8s, 9s, and 10s. So as the market slows down, you get to now go in and say, okay, well, how do I keep my best people? How do I keep my best people and give them an opportunity to be successful? And so those are the things that we're working on right now. Can I create a better model where I can take 15% out of the project costs that I were doing a year and change ago and give myself a competitive advantage? The other thing that we're working on, which we think can be $100 million company, is a company that basically says, hey, if you rent an apartment from us, I'm going to take 5% of what you pay in rent. I'm going to put it aside for you in the account, and we're going to build up money so you can go out and buy your own house because we believe in financial freedom. We think it's a differentiator for all of our buildings. People will stay longer in our buildings. They'll want to rent from us. And in the meantime, this program will make money on the other side in taking all those tenants and getting them into houses. So, while the market is tough in certain areas, that means there's opportunities in other areas. Like imagine the amount of pent up demand there is to own a house. And if I create a program like that and start to build a database for that while we're in this terrible market, there's probably a lot of money down the road for me here.
I love the concept of the 5% going into an escrow account and helping a tenant who may never have any type of savings save up for a property. The other question along with that, though, is do you have credit experts helping these tenants to increase their credit so that they will qualify?
So the good news is, the short answer is no. And the reason is most of the tenants are already pre-screened to rent. So when they're renting, that we're already qualifying them based on income, we're already qualifying them based on credit. So generally, the people that we're offering it to really are people that already qualify.
Well,
So
that's smart.
that makes it easier.
John, Gary, may I jump in here because there's okay. I love how you and I just wanted to get in the weeds on that one, John. That is a really interesting business. You just dropped a little note there. Think of the innovation that's going through your company right now. One, you're saying, how are we going to reorient our company to be more competitive in this tough market, which will end up making us stronger as we come out of these tough markets in the future. But two, you came up with this idea that what if I escrow money for people? Now, I'm going to pretend, I'm going to guess a few parts of that business model. You tell me if I'm pretty close. Because you created this vertical integration, is that money, that 5%, let's use simple numbers. Somebody's paying you $2,000 a month for rent. Are you saying that about $100, I think that's 5%, $100 of that $2,000 is going into some other account? Right? Correct. Okay. Mm-hmm. And a year ago, were you still charging them $2,000 a month, and now you're just reducing your cash flow by 5% theoretically?
No. So what's happening is the building owners are not paying the $100. The company that we own that is going to take those people and take them down the road to home ownership, they're paying that money.
Okay. So it's coming out of your management company in a sense.
It's coming out of a separate company, and that company's only job is to take people and get them into home ownership.
I love it. But then ultimately, I'm hoping this is the case because I think it'd be a virtuous circle. This is a great idea of a virtuous win-win. I hope it's good. Are you putting in some kind of escrow account that has clauses that says when you use How Group mortgage and How Group real estate, you get the access to this escrow?
You have to use our approved vendors, correct?
There you go.
If you don't use our approved vendors, then we can't do it for you.
What a great model. So basically, you're I don't know how I call it daisy chain capital sometimes. It's like you're putting the 5% over here. Now it might be in some account, which is probably making you have some deposits, which is good. And then you're saying in the future, it's like it's a down payment on other fees I'm going to collect and create a virtuous circle or daisy chain capital. The same dollar is going to work for you in many ways. One, it's going to create a cash account and a deposit account, which stabilizes your overall balance sheets. Two, it's going to get you a client later on. I had an old partner who used to do leasing, and he described it as a rubber band around their bumper. He said, for 2 years, they're going to be coming back to me. And then at the end, they're going to give me the keys back and I'm going to sell them another car. It's like rubber bands around their bumper. They keep getting pulled back. So really ingenious models.
Yeah. Okay, John, sorry.
Thanks, bud. So I was going to ask, how many units do you currently have, and are you rolling this program out to all of those units? And when does the program start?
So the program started, we rolled it out to, our 1,200 or I think we have 1,600 tenants that rent from us. So we rolled it out to our 1,600 tenants, and we're getting a tremendous response, better than we expected out of the gate for the program. So we're really happy. Once we're working on some tech pieces so we can bolt it on to management softwares and different things. Once we have it all finished up, then we're going to bring it out to the broader market. So our first step is we'll test it on ourselves. Our second step is we'll take it to other developers we know and get it in 5,000 or 10,000 units. And then after we test it there and we feel like, okay, it's really running, then we'll get in 100,000 million units. And then it really becomes spectacular, right? So that's the goal.
I love it.
But I'd like to step back though 1 second, because we, one of the things that I wanted to focus on is the idea that, hey, we have this company, this group of operating companies losing a bunch of money. And I'm still bullish on moving forward in our market. And the question is why? Why am I not afraid to move forward in that market? Why do I feel comfortable that we can come back out the other end of this in a better spot? And it's not because I have some cash flow coming from the properties, right? It's because I know that if this is happening to me, it's happening to a lot of other people. The one advantage that I have is that we've saved a lot of money over the last 15 years. So, I'm losing that money. I still have reserves in the companies. I still have no debt and a bunch of operating capital, right? And so I'm in a position where while I'm sick to my stomach that we lost a bunch of money, I'm comfortable that we built the companies over 15 years to go through a downturn, to lose some money, and to come out the other side of it with a good plan.
I love that. I love that. Very smart, Gary. And what would you suggest? So, we're all entrepreneurs. We all buy real estate. For someone just starting out in real estate, these rates and with the storm hitting, what are some of like the key points you would recommend to a new investor?
So a couple things. Obviously, if I'm looking at the trends, I see that there's a pent up demand for home ownership. So if there were a way for a young investor to go out and buy 1 to 4 family properties that just kind of covered themselves and knew they were working because the equity was growing. And when this market does hit and all these buyers do eventually kind of hit the market, that should increase values and you can make money that way, right? You're not going to make cash flow today, but you're building a foundation for the future. That's kind of number one. Number two, like if you're not doing that, where is there opportunity today? There's a ton of opportunity in affordable housing, right? There's a lack of affordable housing. There's great programs. If you're in the city of Philadelphia, there are great programs out there to help people buy affordable housing. That's a market where there's a huge need, and there's people putting money into that spot from a governmental end that's available to you. So I think there's an opportunity there. I'll give you an idea that I'm working on because I'm looking at so in the past, if you decided, here's one of the problems with rates going up, right? Somebody now can get 5.5% or 6% on their money by just putting it in, corporate bond or something like that. So you're saying, well, why the heck would I ever invest my money with you in a piece of real estate where you're going to give me 8 and I can get 6.5 essentially risk free? And so I got to get that 8 to 12 in order for you to want to give me that money. But there is no real estate deal out there today that's paying 12 in the multifamily market, right? So one of the ideas that we're exploring is, well, we always have, say I build a 50-unit building and it has 5 or 10,000 square feet of commercial space. I'm looking at, well, can I find franchises that I can buy and put in my commercial space? Because they typically return 15 to 20% on the capital invested. And now if I blend that into my real estate deal, my 8% becomes 12 to 15. So I can say to my investor, hey, look, this business that we're going to invest in over the last 3 years, they got a 95% success rate because they have to file it in their franchise documents. So I feel like this is pretty risk-free. So if I take a 10% risk-adjusted, adjustment to what I would do in real estate, and now I can get that return for you up on the other side of it into the 12 to 15% return on a cash basis. Well, now we got something again. Because right now, just underwriting real estate, it doesn't work. It simply doesn't work. And so, you got to come up with creative ways to do it. And I'm not saying we're going to implement that strategy. I'm just saying that's a strategy we're looking at. You got to find a way to just look at it a little different than everybody else, or or you got to just sit on the sidelines and wait till the market comes back. And I can't do that. I just don't operate that way.
Yeah. Plus, you never know when the turn comes in the market, so you want to be active and moving and grooving. And if you shut the whole company down, you won't be agile enough to do it. So let's dig into your cool strategy there for a minute, because you do build beautiful buildings in urban settings. So you're saying that the retail space on the ground floor might be good for, let's say, even a Starbucks type thing or some competitor to that. Mm-hmm. And you're saying we buy that franchise. Now, that's starting to sound like my world, right, Gary? Because I build businesses within real estate, and that's how we outperform. And we can fight through these downturns because we are super cash low. And, that is the only challenge we kind of have. One of our strategies, Gary, have you looked into this strategy of higher capitalization up front with modest cash distributions up front until the market comes back, and then so let's say you overcapitalize a project at, instead of $100,000, 100% coming from a blend of 70% debt and 30% equity. Maybe you're more like 50-50 or 60 equity. You're giving them something for a period of time, but then at refi, when markets stabilize in 4 years or less, now they're getting a pretty sizable return of capital, plus they're going to keep the return. Have you ever modeled something like that where you're in a sense letting them get the cash flow that bankers should normally get?
So yes, we are looking at a model where we only take potentially 10% or 15% bank financing.
Wow.
And raise a bunch of money and change around the way that the capital stack works.
Right.
We are looking at that. And I believe it's a much better model. The biggest challenge is now if you had to raise, $5 million to do a $20 million deal, now I got to raise 18.
Right.
And so, all of my time will be spent on the road, spending time on talking to family offices and explaining to them why we think this is a better value proposition. So that is something that we're looking into as a way to do it. And I agree with you, is a better model. Look, the bank takes the least amount of risk and is the first one to get paid, right? Why shouldn't our investors have that same opportunity?
That's right.
With a little bit of the upside, right?
Yeah, that's one of our theories. But there's this other thing going on, Gary, and I'm sure you, because of the way you are, one, I've always seen you as just a creative, authentic guy. So how have you done on negotiating either seller finance deals or keeping the current mortgages in place or some type of creative financing? Is that one of your bailiwicks? Is that one of your skills, or is that not what you'd focus on?
So we haven't focused on it to date. Ironically, one of the ways that we're going to increase our stockpile of cash is that we have buildings that had great debt on it, like absolutely perfect debt. I have a property that has 15 years remaining on a fixed rate loan at 3.75% with a life insurance company that's assumable, right? So I can sell that building for a huge premium right now. So one of the things that we're doing is selling buildings that have great debt on it to put cash in the bank to say, hey, look, we think there's going to be a lot of opportunity. Worst case scenario, if we're wrong, we made a bunch of money. Best case scenario, we're going to redeploy that capital and make, and double our returns versus what we had in the building, because the market's tough right now. So we are looking at, how to do different things based on interest rate and that kind of stuff. I do believe you are in a market now where rates are. So for example, we know that if you buy a building and your interest rate is 6%, by the time you pay principal back on that, you're really paying 8%, right? So if I were able to go to a seller and say, hey, why don't you hold financing at 7%? Well, my cash flow is higher, right? So, and people are thrilled to get 7% on their money. So I think in this current market, with interest rates as high as they are, there is an actual opportunity to do seller financing. Like, people that want to sell understand that, it's a tough time for them to sell. And so if they want to get the right number, they should be flexible with some of their financing terms. I think that's a 10 strategy right now.
Yeah, I love that seller financing strategy. And actually, I just tried it on a multi-unit I'm buying next week. Unfortunately, the agent couldn't explain it correctly to the other people. I said, listen, I'm gonna settle on it regardless. But I think I offered like 6.8% for 5 years, because I figure the market's going to turn around. We can, refinance and whatnot. But people forget. I think we've gotten a little bit spoiled. People forget that 20 some years ago, interest rates just to buy a personal home was at 7 and 8%, and we didn't bat an eye. And I think we've been spoiled with the 3 and 4%ers for so long that sellers still want to get that top dollar and don't understand, like, hey, the affordability just isn't there. One of the strategies that Christine and I just plan on doing is, even if we're not making that cash flow when we're purchasing, we know in the future we'll be able to refinance when the rates come down and the cash flow will be there and the equity is going to go up. What are your thoughts behind that, Gary?
Well, I agree with you. Long term, at some point, we'll see rates come back down. And if you can make deals work in today's environment, they're only going to get better, right? Like, I'm 100% for fixing interest rates now and then taking advantage of them when the market goes in your favor, which eventually it will, right? Like, our economy can't support these rates for, for 5 years. It might be 2 years where they stay up this high. But to your point, if you got 5 years at 6.8, I think you can be pretty comfortable that you're going to pick up a percent and a half at some point over the next 5 years. And that's going to be a huge win for you from a cash flow perspective.
Yeah, that's one thing that you probably have really thought about a lot, Gary. Since you've been in the mortgage business, you've probably paid attention to how the mortgage interest rates work and how the government debt and the treasury bills work. So you probably have a lot of opinions about what the future holds. Would you mind teaching us a little more from your perspective on why the economy cannot keep rates as high? Why would you say that? I actually think I know what you're about to say, but for the listener, why should they listen to you? What's your theory?
Well, my theory is it's all relative to the rest of the world, right? So we're in an environment where, in general, the world's in an inflationary environment. And we're, always, not always, but good for us, as long as I've been alive, relative to the market, we're always the safest place to put your money, right? And so over time, I think what's going to happen is that the economies can't afford to service their debt. They're going to have to do one of a couple things, either extend out the period of time that they pay the debt back over. So instead of paying your debt back as a 30-year T-bill, now you're going to have a 50-year T-bill or something like that. Or everybody relatively is going to have to lower their rates back down a little bit, which is, I believe, the second thing that happens. The other reason I believe that is I think that you see in this economy, our inflation right now, in my opinion, is based on really a supply issue, right? Like, we haven't made back up the supply that we need to. Demand is starting to wane. Supply is starting to come back, and therefore inflation will go down. And if that happens, we should see them take their foot off the throttle a little bit and rates should come back down. That's my high-end sense of it.
Yep. I mean, because of course the country itself is paying very high rates on their money now, whereas a couple of years ago these treasury bills were almost zero. So for them, it's accelerating the fragility of the whole economy because so much of the GDP now, it's increasing our GDP drag. So what is the current pundit? What are the current pundits saying? One more rate increase this year and one more in the Q1 next year? That's what I just heard last week. What are you hearing?
I've heard so many things, and generally, like, when we look at what the mortgage industry says is going to happen, generally they're wrong.
Oh.
They're almost always wrong. So, I just prepare for the worst, and then when it gets better, go through it. So my expectation is that next year rates will stay high.
Oh, okay.
Maybe they stay high into the beginning of the following year. We'll see. I think everybody is more bullish than I am that they'll come back down. I'm planning for that and hoping for them to be better, which I think is what most people think. Most people think they're going to raise them a little bit more and then start to decrease them some point next year. Who knows?
It's great. And, as we wrap this up, Gary, are there any other ideas that, or quote unquote hacks that you would recommend for our listeners to look out for?
So it's funny because, people, do these things in there and that term hack, like, to me, it kind of devalues the ability for somebody to be creative, right? Like, I look at it and say, well, how's somebody being creative and looking at the market and finding opportunity, right? And that, how do you do that in this market? If you're an investor, like, one of the spots that I think, one of the things that we're looking at, I'll give you another example of things that we're looking at. I'm always looking at how much capital do I have and what's the return I'm getting on that capital. Okay. So you might think, well, wow, you have this big construction company and I see your signs everywhere and that's wonderful. And I look at it and say, well, how much capital do I have in that business for the return I got on the capital and the risk that I'm taking? And it's not good enough. It's not good enough, right? So on paper, it looks really good. But one of the things I look at is there's a lot of businesses out there that people have owned for years that are good quality businesses that they don't have people to take over. And so if I couldn't make a real estate deal today work, I'd be looking at those businesses and trying to get seller financing and doing all the same things that people have done with real estate in the operating business world. I think there's a lot of opportunity for somebody that wants to put the work in, and those guys make really, really good money.
That's a great recommendation.
It is. Gary, it's awesome to see you. Well, would you mind sharing a little more how the people can find you or your company online? Because it's great company.
Yeah, just www.howgroup.com.
Yep.
And if you want to email me, my name's Gary. So it's just Gary@howgroup.com.
I love that. Thanks for making yourself so available, and can't wait to see you again in person.
Yeah, a couple days, I think.
Yeah, we're getting together. Thank you, buddy. We'll follow up soon.
Absolutely. I appreciate it. It was wonderful talking to you guys.
Damn straight. We just got
buddy.
We got to the end of another great show, and everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love you. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.